All right.
Good morning, everyone. Just gonna let you guys file in here and give a couple more seconds.
All right. Very good.
I think we're good.
Let's get this going. Well, good morning, everyone. Happy July 16th. Today's July 16th, 2026. Welcome to AllGen's quarterly update and market review. It's been half a year. That's it. Half a year's gone, half left, and it's been a busy year. A lot of stuff happening. So we're excited for you to join us or listen to this webinar as we eager to share some updates, what we see happening in uh, local economy, global economies, markets as a result, etc. Before we do that, I just want to give you an idea of what we're going to go over today. We're going to introduction is what I just did. As you guys know, we do this on a quarterly basis, and we're going to do some fun polling questions. We'd like to get you engaged, so we'll do that in a second. Jason will do his market review and outlook. Then I'll give you some updates at the end, and then we'll do some live Q&A. For the Q&A, as you can see on the screen, um, you can't raise your hand during the session, but there's the Q&A box. Please feel free to click that and type any questions you may have. The format is normally we leave the questions till the end of the presentation, unless it's a screaming, very pertinent. Well, I'll interrupt Jason to say, hey, as it pertains to that, but I'll try to let Jason do his thing and then promise that I'll go back to every single question. I think there's one time we weren't able to answer all the questions and we just manually answered them individually to the person who asked. But please feel free throughout the session at any time to drop and as many questions as you like about anything that's related to this, or even if it's, I mean, related, hopefully economic or investment related. So anything that we touch upon or things that you may have on your mind. Okay. So that being the case, let's start with some engagement stuff. And we have a couple of questions for you. We normally start with one that's a little bit more lighthearted and one that's a little bit more serious. So the first question, as you guys know, a lot of buzz around the World Cup these days. So curious, and this is pertains to you at some level or another. Who will win the 2026 FIFA World Cup trophy now that yesterday the second finalist was locked in? Do you think it's going to be Spain? Do you think it's going to be Argentina? Or do you want Spain or Argentina? So either think or want. I'm just here for the snacks and drama, or I really don't care. And my office knows my opinion on this. I'm not a big soccer guy, but hey, it's been interesting and amusing to follow it this year. So give you a second to answer those questions and see where people lie with regard to the FIFA World Cup. And survey says we've got a lot of people, most people believing it's going to be Argentina. Okay, interesting. Okay, so they are the reigning champs and will continue according to most people, or they want that anyway. Secondly, we've got if a child in your family received $1,000 to begin investing, where would you invest it? And this might be misleading because the caption is called Trump accounts, but we're not trying to sway you either way. Would you put in a 529 investment account, a Florida prepaid savings account, an UTMA custodial account, a Trump account, or would you spend it on a vacation experience? Which would you say? And this could go for whether you have a child or not, or if you did have a child or you know someone with a child, what would you advise? So we'll give you a second to wrap your arms around that. And we will actually be talking about Trump accounts in the near future here in a future blog and webinar and video. Oh, wow. 50-50 split. Interesting. So 529 and Trump account. All right, very good. That's good feedback. So again, please feel free to ask any questions as we go, type them in there. And with that being said, I will hand it over to Jason. Take it away.
Hey, thanks, Paul. Let's jump in here. Got a lot to cover today. So let me just get this next slide pulled up for you guys. All right, so we're going to start us off here with where the market has gone year to date, all over the place here. As we have experienced some wars and some other things going on as we started the year. So the green line here represents gold, and you can see gold started off really, really strong. And then actually now gold's the worst performer of the year, down 6%. And then one asset class that hasn't done all that great over the last, I would say, 10 years in comparison to other indices is small caps. And small caps have actually been the one to outperform this year. And then you have international, which outperformed the S&P last year as well, but it's doing the same thing year to date. And then S&P up just about 11%, and bonds are essentially flat for the year. So that's where we stand as of today. But as you can see, the market's kind of been all over the place. When the war happened, a lot of things dropped, and then things started coming back after that. And the market, for the most part, is pretty close. The stock market, anyway, is pretty close to all-time highs. All right, so well, we thought things were settling down on the Iran war, but wouldn't didn't probably didn't surprise a lot of people that the drama is back, if you will, and not to talk down on such a difficult experience, especially for those people living in Iran or in the Middle East in general, or if there's any servicemen over there. But at the start of the war, you can see this is the price of oil. And so oil was kind of hovering right around 60, let's call it $67 right here at its highs pre-war. And then the war started. You can see that barrel of oil got up to about 120. This is the WTIC, not the Brent, so Western Texas oil. And then you had the ceasefire that started kind of in early April, and that was kind of back and forth for a while on the ceasefire. And then you had the MOU that was signed, which it looked like a lot of it did for a while. A lot of the attacks started, and a lot of the flow through Hormuz, the Strait of Hormuz, and the tankers started ramping back up, which I'll show you here in a second. But that brought oil all the way back down to pre-war levels for one day. It got there. But now the ceasefire has been called off, and it seems as if we're back into war mode again. You can see that oil has jumped about 20% from its low. Still significantly lower than where we were up here at its highs. But at the same time, it has spiked up over the last couple of weeks here. So as we look at what we've been talking about a lot as the war started is the biggest part of this from the market standpoint is oil and natural gas. Oil and natural gas, 20% of it of the world's supply at the start of the war came from that region and the Strait of that Gulf region that you have to go through the Strait of Hormuz. So this is just tracking total vessels, which would include all types of vessels, including oil and gas tankers. This line, as you can see, there's one single line here, kind of represents pre-war levels, which is around 135 total vessel crossings per day. And then you can see, obviously, it went down to near zero. And then as the ceasefire started, and especially ceasefire started kind of like right around here. And then as it got a little bit more and more flow through, and then the beginning of June, right around this kind of level right here, we started the MOU agreement, and where the kind of war stopped, missiles stopped flying. Iran said they would open up the strait. The U.S. was helping different vessels get through, and we got all the way back up to about 50 vessels a day. There was one day where it got significantly more, but that really started helping bring the price of oil down. And a lot of times the market is forward looking, so it's thinking not just where are we at today with the flow of oil, but is this trending in the right direction, and where will the flow of oil be 3 to 6 months from now? Two, where will the demand be, and has there been any other supply adjustments? So a couple of things that have happened, even though, as you can see recently, when the war kind of started back up again, we're back at very low levels, kind of where we started the war in terms of the amount of vessels flowing through the Strait of Hormuz. So that's why oil is popped back up. However, as you can see, back to this slide that we're at here, we're not back up at these levels anymore. And there's a couple of reasons for that I think is important to point out. One, there's been different countries like OPEC Plus and other countries that have kind of ramped up production. So start increasing supply from other areas. There's been other ways that the Gulf states have been transporting oil to other ports so that they can not have to go through the Strait of Hormuz. And there's a large pipeline that's being built right now that'll move about a third of the total oil that's currently going through the Strait of Hormuz to a different, safer port. So that's been happening, and at the same time, demand of oil has actually come down. So those are factors that we're watching over, and it's not all dependent on oil going through the Strait of Hormuz, but that obviously is still a big factor and one that we'll continue to monitor going forward. And one last thing on this and the whole price of oil, it's important that we follow this because oil can be a driver of inflation. Not only are we paying more, obviously, for gas, but then that flows through to suppliers, which sometimes will flow through to the end product. So they can affect inflation. I got a chart on inflation I'll show you towards the end of the presentation. But that's why we pay a lot of attention to oil, because inflation can affect interest rates, which can affect a lot of other things. So, all right, let's jump around here to a different way to look at the markets. We put a big emphasis on sentiment, and sentiment again being how the market feels about how the investment community feels about the market. And we put a big emphasis on this because it's one of the most accurate indicators of market direction, especially at extremes, and more so at extremes. In fact, it's one of the best indicators at finding a bottom in the market. And it's exactly counterintuitive to what you would think. So when people are very excited about the market, from a sentiment indicator, from a contrarian indicator standpoint, that would mean the market is more at risk. So this bottom line here, the top line is the S&P 500, but the bottom line here is measuring a number of different sentiment indicators, and it's coming up with one composite of some sentiment indicators. So when it gets toward above this dash blue line here, it's showing extreme optimism. You can see this is one of the highest points in the chart, and you can see that was this point right here, right before the market fell. So when people are very optimistic, that does add a layer of caution, if you will, a red flag on the market. And you can see when we're above, down here at the bottom, when we're above 62.5, which is this dashed line, when sentiment is extremely high, this is the average annual percentage gain annually is -5%. So that's important. Now, on the flip side of this, in fact, in most cases, actually, the extreme pessimism is even a better indicator than extreme optimism. So you can see how this bottom right here, when the war started, that coordinated with this bottom. And then after you hit that bottom, the market went up significantly higher. You can see the pandemic low, and that was an extreme scary time for the market, or extreme pessimism by the market, and that was right there. The market went up a lot. And another great example is the tariff scare last year. That represented that bottom of the market. So when the sentiment is below 41.5, actually markets have been able to have an average annualized return of 25%. So that's why we pay so much attention to sentiment indicators. Now, we were in an extreme optimistic time frame recently, not the most extreme that we've been over the last 6 or 7 years, but we were above that 62.5. We aren't anymore. We're slightly below it right there. So we're currently kind of neutral from a sentiment standpoint. And that may surprise some people, because a lot of people, and I will just speak with a lot of clients that think the market, or think people are very excited about the market. And there's others who think that I guess it depends on your circle of influence. The other people think that the market is really scary right now, and people are more pessimistic about the market. But we're actually in a neutral point right now. So there's not a lot to do from a sentiment standpoint right here. We're not an extreme either direction. And when we're in this scenario, markets have averaged a return of around 10%. Now, that's one way to look at sentiment. Another way to look at sentiment is how the consumer feels. So this isn't necessarily looking at how the consumer feels about the stock market, but how the consumer feels about the overall economy, and how it affects their consumption. If they think things are really expensive, this consumer index will typically be very low. If everything's going great, they're making a lot of money, and prices are a lot cheaper, like think about late 90s, then sentiment gets really good. So we're at one of the lowest points in time over the last 50 years right now. So sentiment has, the consumer sentiment has been very, very weak. Now, that may sound like a bad thing, but as I mentioned in the last chart, it's contrarian. So when the consumer thinks that, or feels like, or is very pessimistic, if you will, that is typically good for markets. So as you can see, November 2008, we reached an extreme, and markets went up 22% at that time. Same thing in 2011, market went up 15%. 1980, market went up 20%. In February 75, up 22%. and then in June 22 up 17.6%. So during the sentiment troughs, meaning the lowest points, markets have averaged 24% return over the last 12 months. And during the 10 sentiment peaks, they've only averaged a return of 4.8. And so now you can kind of see why we put so much emphasis on sentiment and why it's something that we pay attention to. As an investor, you have to keep that in mind, because if you're really scared about the market and if you think things are really bad, and especially if a lot of people around you also think the same way, then it's probably time to get into the market. It's probably time to put more money into the market, because historically, that's when the market's done really well. So I say this, one, to kind of show you where the market's at right now. Two, we always want to teach investors how to be better investors. And when things look scary, that's usually the best time to invest. And I'm not saying the market's going to go straight up from here and it's going to continue to have a strong time period. But what I am saying is it's very difficult to judge your feelings, or don't use your feelings to judge if you should invest in the market. It's usually the worst indicator. You should almost do the opposite of your feelings, or the opposite of the herd, if you will, or what the herd is feeling. All right. So this is one last slide. I showed this last time, but when we're at the level that we are at right now with consumer sentiment, over the next 3 years, the markets have been positive 100% of the time. There could always be that anomaly, but that's a pretty good track record. Over the next 1 year, markets have been positive 92% of the time, with an average return of almost 20%. So keep that in mind. All right, so now switching gears, looking over at valuations. This chart's a little bit busy. I'm going to focus on this left section here, this where we are right now with the overall kind of the S&P 500 and its forward PE. We're at a 20.4 right now. The long-term average, or the 30-year average, is 17.2. So from that standpoint, the market's just slightly under one standard deviation of value of where the historical valuations have been from a forward PE ratio standpoint. And the only other higher time in the last kind of 40 years has been the late 1990s. We came near where the peak is right here in 2020 before the market took a hit, kind of during that pandemic drop. So markets are actually, excuse me, this was right before the pandemic drop, but right after the pandemic drop and going into 2022, we went into that bear market. People were really, valuations got really high at that standpoint too. I say this to say, valuations are a better indicator of kind of the longer term returns in the future, especially at extremes. But from a short term standpoint, you don't know where the market's going to go based off of valuations. And there's a lot better track record of where valuations are and then the subsequent 5 years than where valuations are in just the subsequent 1 year. And from a 5-year standpoint, when valuations get this high, in general, the next 5 years of returns are lower when valuations are higher. So, however, we are just looking at the S&P 500 here. This would be large U.S. stocks. And a couple other valuation metrics here, just to show you. Some people point out the CAPE, or what's called the Shiller's PE ratio, which kind of factors in inflation and 10 years of earnings into it. And so that's high as well. Dividend yields being lower than its average, which shows that markets are U.S. stock markets, large cap, are higher. And then this indicator right here kind of shows you that in general right now, bonds actually have a better valuation than stocks. I say all that to say, because a lot of people point out that valuations are high, and they are. And that's something that we pay close attention to. However, if we look over here on the right side, you can see this looks at every kind of style box and market cap. So style box would be like value stocks versus growth stocks. And then in between that would be blend. And then if you look at market cap or the size of companies, this would be large, mid, and small. And the S&P 500 is essentially right here. Okay, so yes, that is, and what the percentage we're looking at here is the percentage of its 20-year PE, floating or forward PE ratio. And so if it's above 100%, that is more than what the 20-year is. If it's right at 100%, that would be kind of at its average over the last 20 years. If it's below 100%, that would be considered to be trading below the valuations over the last 20 years. So I highlight this red box here because if you can see the small and mid-sized companies, both value and blend, are actually trading closer to the long-term averages. In fact, small cap value is slightly below long-term averages. So yes, while the S&P 500 is a bit expensive, quite a bit expensive, there are subsegments of the market that are still closer to kind of long-term averages. Now, some people are wondering, like, how does this market continue to go up higher and higher? We have all these tariffs last year, and then we have wars going on this year. What's causing this market to go a lot higher? It's really a margin story. And what I mean by that is profit margins have continued to go up higher and higher. So this chart on the right here is looking at profit margins. And that's how much companies are making. If you take kind of your revenue, subtract out your expenses, that's your profit. And then you take that and you divide it by sales, and that's where you get kind of profit margins. As that number gets higher, companies are making more money based off of the amount of revenue that they have and the profits that they're taking from that. So that's a good thing for stock markets. Stock markets are driven a lot by profits. And then the other thing, as you can see here, earnings growth, which is driven a lot of times by margins, has been extremely high. It's this year, in fact, we're looking to grow at 24%. Earnings could potentially grow by 24%. That's the estimate right now for this year. If you draw a line horizontally from that, we haven't hit that level since after the great financial, the 2008 time frame where markets took a big hit. I kind of consider this an anomaly because this year 2021 was coming off of the pandemic, and the market was throwing a lot of money, or the Federal Reserve and the Treasury were doing a lot of stimulus. But outside of that one anomaly, this is the highest that earnings have grown over the last like 15 years. And it still appears to be pretty high over the next 2 years, although slowing its growth, still growing at a good percentage rate, but slowing from this year. At least that's what estimates are right now. And so that's been a good thing for markets, as and a lot of that could potentially be coming from a number of reasons, but I think the biggest one is AI. AI is causing productivity to increase significantly faster, and that's helping margins quite a bit. People are able to do significantly more in a shorter period of time with that new technology. So just another kind of slide to point out, what's driving this market. If you look at kind of what they call the AI hyperscalers, the Mag 7, if you will, the Alphabets, the Amazons, the Metas, the Microsoft, the Oracle, these companies are pumping in a ton of money into capital expenditures that are help building out the whole AI network and everything behind it. So as you can see here, this is how much money they're spending in those areas, in billions each year, and what they're estimating to spend this year and the next couple of years. So a lot of money is being put into that, and compare that to where we were over the last few years, and that's just those companies right there, just the hyperscalers. Looking at that from a percentage standpoint, the green line represents the percentage that they're putting towards capital expenditures, and they're putting nearly 40% of their sales into investing into the AI and building out all the infrastructure behind it, compared to where they were, 5 to 10%, even 15% over the past 20 plus years. They're putting a ton of money into this, and that is increasing their cash flow. So you can see cash flow is going up a lot. However, the free cash flow of those specific companies has gone down because of how much they're investing in the future. But as they invest in the future in that, you can see here, as they start to tail off, spending a little bit on the capital expenditures in this area. Remember, this is not spending less, but it's just the growth of the percentage of their revenue coming down from how much they're spending. As you can see here, from a dollar amount, they're still spending more. But as that becomes a lesser amount of their total sales that they're investing in building out the infrastructure, their profits their free cash flow is expected to go up significantly after that. So that's another driver, and that also feeds into that slide I was just showing you. Now, some people, and I would probably be in this camp, are wondering, is the AI, especially a lot of the semiconductor stocks and semiconductor sector, kind of in a bubble watch in this area. Like, some of you guys may be familiar with like the Microns and some of these companies that have just, absolutely gone exponential on their price Micron, for example, has gone from $60 a share up to like almost $1,200 a share in a matter of a year and a half. That's a crazy amount of growth, and that typically is not sustainable for a price of a company to go up that much. So it is something that we're looking at and monitoring closely. I would say if you hold any of those stocks, I'm not telling you to get out of them. They could go up higher, but they're definitely at a much higher risk right now. And we have taken some profits off of the table a little bit in those areas just because it becomes a lot riskier. But sometimes big bubbles get a lot bigger than you think they are. And it is certainly possible that we could be in a super cycle that is causing this area to go up much higher for a longer period of time than what a lot of people are thinking. However, the risk is now higher that since valuations are significantly higher. All right. So this is a chart that we've been referencing quite a bit. It's a very important one because it has a lot of influence over a lot of other sectors and asset classes. But this is the trend of the dollar. And we were coming up to an area last year, and even at the beginning of this year, where it looked like we were going to test this long-term uptrend. The actual, and a lot of people don't believe this, but the dollar's been uptrending since 2009, as you can see in this chart right here. And we tested this trend line right here, and it actually held that trend line. And right now it's starting to bounce and go higher. The jury's still out if it'll continue to bounce and go higher. But gold has a big influence over a lot of things. Excuse me, the dollar has a big influence over a lot of things like gold, like international stocks, interest rates. Actually, it's the other way around. Interest rates sometimes drive the dollar, but that's why we pay close attention to the dollar. Now, if we were to zoom in, so just zooming in this section right here and this next slide, you can see that over the last about year and a half, the dollar did build a little bit of a base from when it pulled back. It pulled back in this area right here. Then it started building this base right over here. And you see over a year and a half, if you're looking at a stock chart or equity chart, index chart of any type, and you see this base being built, and then it breaks up from that base right there, that is typically a good sign for whatever market that is. In this case, this is the dollar, and it did break out. Now, in technical analysis, when you break out from a prior resistance, this gray area would be prior resistance. Prior resistance is defined by prior highs. It acts as a ceiling. But when you break above that, like it did right here, usually now that prior ceiling becomes like a floor or what's called support. So if we initially broke out, now it's pulled back to that floor. We'll see if it can hold that floor and go up higher from here, or maybe this just ends up being a false breakout and the market goes lower. Now, with the price of oil and what kind of goes behind the petrodollar, when oil breaks out and goes higher, a lot of times that can drive the price of the dollar higher. And so as oil went up, it caused the dollar to go up as well. As inflation goes up, it can drive interest rates higher. When interest rates in a currency goes higher, that can drive the dollar or the currency of that country higher. There's been multiple forces that have kind of driven the dollar higher, and it's something that we are monitoring right now. If this continues to break out, it may mean that we need to continue to potentially reduce gold, reduce international stocks, as those tend to do weaker. They're negatively correlated to the dollar. So as the dollar goes up, those asset classes go down, and that's what this chart right here shows. So looking year to date, the gold price is in yellow, and the dollar is purple. So as you can see, the bulk of this trend right here, the dollar has been going up, and as the dollar has been going up, gold has been going down. So those are negatively correlated, which is why it's very important to keep an eye on the dollar if you are invested in gold, and that's a big reason why gold has had a difficult year so far, because the dollar has been strong. So while we have reduced a little bit of our gold position, we still do believe gold is in a secular and trend analysis, means longer term trend, like 10 to 15 plus years. We still believe gold is in a secular trend. So if we kind of zoom out now at gold, not just looking at this year right here, which is this little blip, but looking at it from a longer term, you see gold goes back and forth from secular bull market to secular bear markets. And we believe we are still in a secular bull, and that upward trend has not broken yet. However, it has dipped here recently. So now this chart is looking at not just gold, but gold is basically it's a ratio. It is a ratio of gold divided by the S&P 500. So when the line is going up, that means gold is outperforming the S&P 500, and when the line is coming down, it means the S&P 500 is outperforming gold. So you can see in the 70s when we had high inflation, gold did really well compared to the S&P 500, and then when the bull market and stocks started in 1982 and interest rates started coming down and inflation started coming down, the S&P 500 did significantly better than gold. And then you kind of had, from 2000 to 2012, gold did a lot better. It was actually, I think it peaked out in 2011, but and then it ended up having the S&P 500 significantly outperformed over the next 10 or plus years. However, this is the part that I want to focus on right here. Since 2025, gold has started to outperform the S&P 500 again. Now, recently, as the dollar has gone up, it hasn't. Gold, like I showed you in that first chart, gold is down for the year where markets are up. But we will have to keep an eye on this trend line to see if it's still going to continue to outperform the S&P over time. We believe we're going into and we're already in a secular outperformance of gold to the S&P 500. So that this is a chart that we're keeping a close eye on. And it's not just looking at it from a charting standpoint, but also looking at the fundamentals behind it. This chart right here shows gold as a share of official reserve assets. So what are central banks doing around the world? Advanced economies, you can see, are increasing their share of gold as their official reserve assets. So instead of holding assets like the U.S. Treasuries, they're holding assets like gold. Emerging markets are also doing the same thing. Emerging markets would be this line right here, and then the world as a whole. In all cases, you can see here that they are adding gold as part of their central bank strategy to add reserve assets. It's more so gold now than it is treasuries and other bond instruments. So there's money coming into gold, not just the price isn't just going up, and we're not just looking at the chart from the price going up, but there's actual fundamental data that backs why gold's price is going higher. And as we always try to kind of use the weight of evidence, we're not just using charting and technical analysis, we're using fundamental analysis, macro analysis to come up with a conviction of how we place our clients' money into different areas of the market. All right, so similar to gold, but not as pronounced, commodities have actually been outperforming the S&P 500, and especially year to date. So this is the CRB is the commodity index, and it's being divided by the S&P 500. So again, the way this works, if the line is going up, commodities are outperforming the S&P 500. If the line is going down, S&P 500 is outperforming commodities. So really, since kind of the pandemic and we started printing money, started sending out checks, inflation started coming, especially in 2022, commodities significantly outperformed the S&P 500 during that time. But even from point to point at the low here till now, commodities have been outperforming the S&P 500 since 2020, or late 2020. So obviously gold is a commodity, but this is looking at the commodity index, which is a basket of all commodities, all the metals, the oils, the foods, the agricultural stuff, so the entire basket of commodities. So that's something important to look at, because as things get expensive, like U.S. stocks, and people are concerned about interest rates going higher, which if interest rates go higher, sometimes bond prices typically go lower. Those are negatively correlated or inversely correlated. And so they're looking for other areas to put their money that could outperform if both of those markets end up going down at the same time, like we had in 2022. And so commodities are an area that we continue to monitor and even look to add money to on dips, and when we think inflation is going to continue to go higher and commodities will outperform the S&P. So I just point out a couple of different, zoom in on a couple of time frames here. You see for a long, from 99 to 2009, commodities, this is the same chart we were looking at before, but just zoomed in, commodities outperformed the S&P 500 during that time frame. That's a 10-year time frame. And then in the 70s, the same thing, commodities significantly outperformed the S&P 500 in that time. So you will go through these secular time periods where commodities can outperform the S&P. And so even though there's been a long time period from really the 80s up until about 2020 with a blip in between of that 2000 to 2009 period where the S&P has significantly outperformed commodities. I'm showing you long-term time periods here where that is the opposite, where the commodities have outperformed the S&P. So we could be going into another kind of regime, if you will, during that time. Now, this is comparing the S&P 500 to international stocks, and this is developed international stocks. And I point this out to say, well, one, let's explain the chart. So if this line is going down, it means international stocks are outperforming the US. If the line is going up, US stocks are outperforming international stocks. This segment right here is when the dollar was downtrending. And you can see when the dollar downtrends, international stocks tend to outperform. Remember, this line's going down, international stocks are doing better than the US. And then, we did have the dollar started to go down over the last 3 or 4 years, I should say. However, it's rallied this year. But we could be going into a new secular trend change if the dollar does end up being a false breakout and starts going lower again. As you can see with this trend line, international stocks have started to outperform. We will see if this continues to be the case. We were overweighted over the last couple of years in international. We pulled back to neutral with the dollar started to go up again. But if this line and if the dollar doesn't end up breaking down and gets weaker, we'll probably go back to overweighting international stocks. So this line is comparing the S&P versus developed international market. This next line is the S&P to emerging markets. Very similar scenario, except for emerging markets tend to move even stronger in both directions, up and down. But this is during a weak dollar period. You can see how much emerging markets outperform the S&P 500. When the line's going down, emerging markets are outperforming versus the S&P 500. And also very similar, you can see a potential secular change here where we started to test this long-term trend line, and it could potentially be breaking down here. We'll see if this ends up breaking down, but that's, again, something that we're going to monitor closely along with the dollar to see which direction we go there. Now, back to valuations, but now looking at valuations outside of the U.S., the purple line would look at where valuations are right now. I'm going to focus more on that versus the 20-year average, which is this line right here. And the dark shaded gray line is just the high and low point, kind of the range over the last 20 years. And so this is the US. And as we already pointed out, the US is expensive compared to, their valuations are much higher compared to its 20-year average. But if you look here at the purple line of emerging markets compared to its 20-year average, it's actually right there at its 20-year average. So there are areas around the world that are significantly are not as overvalued compared to their historical averages. And this is kind of non-US in general. You can see it is overvalued. The valuations are higher than its average, but not as pronounced as what the US is over its average. Okay, so valuations aren't significantly out of alignment or aren't high internationally speaking, but they are in the US. Okay, changing gears again, we're looking at cyclicality. Cyclicality is a study of cycles, and I found this chart very interesting by Ned Davis Research. It's a research company that we use, but it's combining 3 different cycles. So the blue line here is the average of markets on a given year. So, but it's using the 1-year cycle, so the average of all 1-year cycles. It's using the 4-year presidential cycle in cyclical analysis. The 4-year presidential cycle is very significant. And it's using what's called the 10-year decennial cycle. So every 2026, 2016, 2006. And those cycles over time, if you study them, do have a lot of relevance and show a lot of similarities. But what I'm wanting to point out in this slide is typically during the first half of the year, especially the first kind of through kind of April, May, markets tend to do strong. And then from like around May all the way till October, markets tend to do weaker, and especially kind of this August through October timeframe. Markets tend to be weaker in that time, in that period. This yellow dash line is this year's market. I don't only use cyclical analysis, or we don't only use cyclical analysis. We study a lot of different things. But cyclically, this is kind of the time of the year that we're going into where markets will tend to get a little bit weaker. And historically, based off a number of different cycles, markets tend to bottom out, or not bottom out, but they tend to make a low point throughout the year, not the lowest point, but a low point around October. And so as we kind of go into the next few months, there is a chance the markets could pull back as we kind of go into the cyclical weak time frame. And we're aware of that. And so we have kind of dialed back a little bit of stocks based off of valuations, based off of kind of done a lot of rebalancing too, selling off some of the most expensive areas and trying to position the portfolio not fully defensive, but a little bit more defensive than it was a few months ago. And we may need to, and we're continuing to monitor markets to see if we need to make this adjustment. We need to go a little bit more defensive as we kind of go into this time frame. But I don't want to scare you guys because this is just a short-term time frame from a cyclical standpoint. You can see the strongest time of the year is actually October through January. So I'm not saying get out of the markets. We're not doing that whatsoever, but we do make small tweaks to the portfolios to position a little bit more defensively at certain times of the year. And this is kind of the time of the year where we would typically do that. But then we would keep an eye out if markets do pull back. Then we look to go a little bit more and add to the portfolio when it's a little bit lower to take advantage of what they call the Santa rally or Christmas rally. So anyway, interesting slide, does have some relevance. And then now switching gears, looking over at bonds. Bonds year to date, the highest area, which is pretty funny, the most aggressive or riskiest area of bonds have performed well in the least riskiest area of bonds. So high yield, what's called junk bonds and money markets are kind of pretty close to tied for doing the best year to date, up 2%. But as I showed you at the beginning of the year, the aggregate bond is basically flat for the year and hasn't really done anything. The worst performing, which is down about 1.3%, are long-term treasuries. And if you looked at this actually 2 weeks ago, long-term treasuries would have been one of the best. But then the war started back up, yields went higher, and long-term treasuries have pulled back. So we monitor this to see where we want to position, not just this chart in general, but we're monitoring a lot of different indicators to see if we want to be longer duration, shorter duration. Longer duration would obviously be long-term treasuries. Shortest duration would be money markets or just shorter term treasury bonds or short-term bonds in general. So we're monitoring things to see if we should be longer term or shorter term, or which subsector of the market. In fact, actually, emerging market bonds, which were slightly overweighted, both U.S. dollar hedge and local currency have done relatively well this year. So just want to kind of give you an update where bonds are, and just to kind of dig a little bit deeper into this. I want to look at inflation because inflation is an important part of deciding if we should be longer duration or shorter duration. So this is a chart I often reference because it doesn't just give you the kind of end number, which right now we're at 3.5%, but it breaks down the different components of what drives the CPI. And so as you can see here, the kind of the Fed's target over time is 2%. Ever since after COVID, we've never reached that point. Kind of the lowest point that we got was right around kind of 2.3 here. But after the war started, you can see this green area, which was energy, went up a lot. And that kind of fed through to some of the other areas as well, like dining, and some of those areas will be more expensive because it costs them more money to pay for the shipping, and the shippers will charge more for their food because they're paying more for gas. And so you can see that inflation has spiked, but the bulk of that has been energy. And then as you can see, June, when the war started tapering off, energy prices went down, inflation actually started dropping back down again. So again, this is why we monitor the price of oil, because while it's not the stickiest of all inflations, it can kind of subside rather quickly. Where if you look back over in the really high inflationary time, this was kind of caused by wage inflation, where you had a lot more companies looking to hire people and a lot fewer workers. So there's like 2 job openings for every one person looking for a job. That causes wage inflation. Wage inflation is very sticky, and that can cause inflation to stay up for a long period of time. But oil prices are not as sticky, and so as oil comes back down, that can cause inflation to go back down really quickly. So that's why we monitor oil prices, and that seems to be changing on a daily basis here. Interesting note, and a lot of our clients are in Florida and will appreciate this, but auto insurance for the first time in a long time has started going down. So you can see that that's actually going into the negative portion here. Auto insurance is going down. Just interesting side note there. But so as we look at the federal funds rate and where fund rates have been, which is the green area, that's the short-term rate the Federal Reserve charges banks. It determines kind of where money market rates are and what a lot of the borrowing costs are. So you can see after going all the way up to kind of 5.25, 5.5 range, we've started coming down. Now we're at that 3.5 to 3.75% range. And we have 2 lines here, or 2 projections, if you will. We have what the Fed predicts and then what the market predicts. And they're not too far off from each other, but the market is predicting 1 rate hike and then go flat, whereas the Fed is predicting no rate hikes and we stay flat. We do have a new Federal Reserve, Warsh, isn't it, Kevin Warsh? And it seems like, at least by what he says, looks like he may raise rates one time. But from a probability standpoint, from now until the end of the year, actually, we don't have the chart on this, but the probability standpoint of next meeting is around a 75 to 80% chance that they're going to keep rates where they are for the next meeting. But this is looking at by the end of the year. There's only about a 24% chance right now that rates stay where they currently are, which is 3.5 to 3.75. And the highest probability is that we will have 1 rate increase. This is probabilities based off of futures. We will have 1 rate increase by the end of the year. So we will see these numbers change all the time, especially based off of the price of oil recently and the direction where that's going, which is a driver of inflation. And obviously, as inflation goes up, the Federal Reserve, part of their job is to keep inflation low. So as it goes up, there's more likelihood that they're going to raise rates. As it comes back down, there's less likelihood that they're going to raise rates. So one thing that we're keeping a very close eye on is the 30-year Treasury yield. It's reached a point where it hasn't been in the last 20 years. So long-term U.S. government bonds, the yield of them right now is actually about 5.1%. So 30-year Treasury yield, if you are the owner of that bond, is paying 5.1%. And you can see it's gone up a lot from the zero interest rate or the very low interest rate time frames over the last 10 years or so. It's come up a lot, but we're now at that kind of critical 5 range. It hasn't been able to break above kind of that 5.2. Over the last 20 years, it hasn't been able to break above it and stay above it. Now, this next chart is zoom in on this section right here. So if you see here, we hit it back in October of 2025, and then this year in April, and then actually this is 2024, and then we hit it again in April 2025. And then recently, this April, we hit it again. So it hasn't been able to break above this resistance line. If it does break above that, and you kind of break above that ceiling, there is a chance that rates will go higher quicker. And if that's the case, we'll want to go shorter term on our duration in bonds because the longer term Treasury bonds will go, the price will typically go down when interest rates go up. Now, this is what's called an ascending triangle, where you kind of see this is a triangle right here with the gray lines. And this typically would mean, and if I'm going to put probability to it, I'm going to say about a 60% chance that this does break and go above that line, and interest rates start to go higher on the long end of the curve, the longer term Treasury yields. And so that we think there's better than a coin flip chance that will happen. That still leaves about a 40% chance that doesn't happen. So we don't want to anticipate that's going to happen. We'd rather have stronger conviction and wait for that to happen before we ultimately make our move. But it's something that we're monitoring very closely to see if we need to reduce or even eliminate our long-term treasuries and go a lot shorter-term treasuries or even floating rate treasuries that typically do better when interest rates are rising. However, you can see just prior, this is a weekly chart, so every one of these bars represent a week, but just prior to the last few weeks when the war started ramping up again, you see yields are starting to go down. It looked like it could potentially break below this trend line, which means yields would potentially go lower. So that's why, again, why we're watching oil to see if that continues to go higher. It drives inflation, which would cause the Fed to raise interest rates. All of these things are interconnected and something that we monitor very closely. All right, so wrapping up here, this is the last. We got two more slides to go. There is something that we noticed that over kind of that we've been monitoring really since kind of the interest rates started changing. The interest rate environment started changing in 2022 when interest rates started going up a lot faster. The two lines that we're looking at here is we're looking at the aggregate bond index, which is the gray line, and then we're looking at the Bloomberg municipal bond index. And so this is looking at the total return, both the price and the yield combined, looking at a total return. Well, for most of the history up until that point, the aggregate bond index significantly or outperformed. I won't say significantly. At times it was significant, but it outperformed the Bloomberg, the municipal bonds. But that changed in right around that 2022 timeframe, and so there's kind of a new interest rate regime that we've gone into, where we're probably going to be in higher interest rates for longer. And in that scenario, municipal bonds have actually started to outperform from that time frame. So we have started to make a shift in our taxable bond accounts. In our taxable accounts, we've shifted a lot more of our bonds to municipal bonds. And right now, the muni bond, we're using just a proxy for that, which is symbol MUB. It's the iShares National Muni Bond Index, the ETF for that. But its 30-day yield is 3.42. The aggregate bond index is 4.46. So you can see just in general, the aggregate bond index yields significantly higher than the muni bond index. However, if you're in a taxable account, the aggregate bond index is taxable interest. And so if you're in a very high tax bracket, that gets taxed. And I'm using an example of the highest tax bracket, which would be 37% tax bracket plus what's called the NIIT, which is an additional 3.8%. So total of 40.8% tax bracket. If you're in the highest tax bracket and you had to take 40% off of this 4.46%, you're yielding lower from an after-tax standpoint on your aggregate bonds or your taxable bonds. So right now, if we look at muni bonds, they're after-tax muni if you're in the highest tax bracket. And obviously, not all of our clients are in the highest tax bracket, but if you are, the after-tax yield is 5.78, which is significantly higher than the yield, the nominal yield of the aggregate bond index. So you guys may have seen this in the last few months. We've shifted a lot towards muni bonds for this reason. If we believe we are going to be in a higher interest rate environment for longer, and it does make sense to go more munis. We've held off a bit on that in the past because the one thing about muni bonds is that sometimes they do take a bigger hit in extreme markets like 2008, whereas the aggregate bond index held up a little bit better during that time frame. So we like to have bonds that are inversely correlated to the stock market and don't take a big hit. However, in general, at least the index, the muni bonds have a shorter term duration. They're shorter term bonds typically, or at least they are on average right now. So in 2022, actually it fell less than the aggregate bond index. And we've been monitoring it for a while now. And we feel more convicted that we should add a significant or a much larger weight to muni bonds on our taxable bond side of our portfolio. So to wrap this up, and I'm running a little bit long here, but the dollar breaking out impacts our positions as gold in international markets. So we're watching the dollar very closely. Commodities are starting to outperform U.S. stocks. The big part of that is because the war right now with oil going up, but just in general, commodities are starting to outperform U.S. stocks. International emerging markets are outperforming since 2025. And the secular trend does look like that could be changing, where those could outperform for a longer period of time, but they are influenced by the dollar. They're heavily influenced by the dollar. So that's something that we want to watch closely to see if we need to shift that. And then obviously geopolitical uncertainty is still quite elevated. So we do expect that, along with going into kind of a cyclical, weaker time of the year, that we could have a little bit more volatility over the next few months. So we're always going to stay super disciplined. That's a big part of AllGen's philosophy, and try to manage risk as best as possible. And we always try to teach you guys how to be better investors and have a long-term mindset, and not let your feelings drive your or cause you to make an emotional or irrational decision. So I like to say, back to you, Paul.
All right,
Forgive me
very
for my
good.
long-winded talk there.
It's okay. I've been used to it for a long time, but we appreciate all the good information. And as you can continue to do a few more questions, as we're going to try to wrap this up on a timely basis. Feel free to type some into the Q&A. But speaking of information, here's a slide of all our resources. We have blogs, we have YouTube videos, our monthly market insight email. So be on the lookout for those, or feel free to subscribe to our YouTube channel as well, so you can see any updates that are posted there. That being said, also want to give you an update on this is obviously our planning screen, but we want to jump forward to update and welcome a new member of the team. Actually, no, I guess yes. Josh is a new member of the team. He's working with Jason on the investment management team. So we want to welcome. He just relocated here with his wife from Iowa. So that was a big one, because that was a nice drive. Feel free to give him a call and ask him how that process was. But we're happy to have him here and adding some more depth and breadth to our investment management team. That being said, I wanted to share some updates as far as important dates. Summertime usually is a lull for a lot of people, because we're vacationing and camping and summer camping and all that kind of stuff. But we're still busy here. So wanted to make sure we remind you, for those of you with children, back to school tax-free months begins here in a few days, July 20th to August 20th. So if you got supplies, things that are, there's an extensive list online that you can see what's tax-free if you purchase in the next few weeks. Also, tax planning starts now. Now, people say, wait, April 15th already passed. Well, yeah, for last year, unless you filed an extension, you probably wrapped it up. But we're already talking about tax planning for next year, because once the year ends, there's a lot of tax opportunities that are close to us. So that being the case, a deadline for small business owners, a simple IRA, if you wanted to establish a simple IRA for this year to help on your taxes for next year, and of course, investments and retirement savings, September 30th is the deadline for that. We also have filing extensions. So if you haven't finished your taxes for last year, you got October 15th and September 15th. And the interesting part about that is, while you can't do Roth IRA or IRA contributions, you can still, again, if you're a small business owner, establish a SEP IRA and get a deduction for last year, and or solo 401k, depending on what your long-term horizon looks like as far as investing for the future. So those are a few tax planning updates that I wanted to give you guys. And also, we will be reaching out to our planning clients to make sure we have your current information as far as payroll, et cetera, so we can start doing a tax updates for next year in your financial plan. And finally, on the updates, we've got our Money Sense Camp coming up literally in about a week and a half. So if you haven't signed up, or if you have families, if you know of families that have children, high schoolers, that would take advantage of this, please feel free to share that. Information is on our website and on our social media links. That being the case, I want to jump to a few questions, again, being mindful of your time. Jason, one of the questions that came up was, will the Chinese economy collapse due to the lack of oil used by a pro-traded Iran-American war?
Wow, great question. That's a very good question. I don't see it collapsing at this moment. I think if you look at, I don't know if I'm going to be able to bring up a chart, but I'm just going to go off of memory here. If you look at the Chinese stock market, sometimes that's an indicator of where the economy is going. And while the economy has slowed there, it is still pretty strong. And like the Chinese, I mean, while they do have a lot of oil that come from Iran, they have also done a pretty good job of sourcing it all over the place, whether it be South America, Africa, and other nations outside of Iran. So that don't have to pass through the Strait of Hormuz. So I think what will what that could cause the Chinese to do is maybe help influence Iran to kind of go back to the deal making table and get this solidified sooner, and get back to the war stopping. That could obviously be a strategy by the U.S. to kind of put a little bit of pressure on the Chinese by them having to deal with the oil issue and higher oil costs. And it's not just China. Japan gets a lot of Asian countries in general are probably the most negatively affected. But I don't see a collapse. I think those conditions can change very quickly. And who knows, next week by this time, the war could be ended and oil's flowing through it again. So I don't see this as a long term thing where the Strait of Hormuz stays completely locked for a long period of time. And people in general, companies, countries around the world are finding all different other types of paths to deliver oil from and changing their logistics. So I don't think that will be the case, but it is something that we are monitoring the slowdown of the economy in China.
All right, very good. And then I'm going to wrap it up with this last question. It says, you didn't mention much about real estate, and that's been on a holding pattern with interest rates. So given the outlook on rates, what do you think investing or purchasing of real estate lies?
Yeah, and that's interesting. And I wish I actually would have brought that up because I was pointing that out in our investment committee meeting yesterday. REITs, real estate investment trusts, are actually have recently broken out and are heading higher. So the REIT index, which has a lot of different investments, not just residential, actually looks from a technical standpoint much better. Residential real estate, this is a lot more anecdotally, but I've seen some of the charts as well, seem to have peaked. The prices have peaked a few years ago, and it seemed to be kind of slowly going down, especially in the major cities. Kind of big dips and then rebounds, big dips, rebounds, but point to point, they've definitely slowed down quite a bit. So I think the jury's still out there. Obviously, if interest rates go higher, that's going to make it more difficult to borrow, and that usually puts downward pressure on both REITs and residential real estate. But some people are looking at it too as, hey, real estate's a real asset, and if we have higher inflation, real estate could be a good holding for there. So I would just be careful in real estate that's really leveraged, especially with higher interest rates.
All right, very good. Well, we want to thank you again for joining our webinar today. Of course, we welcome any phone calls. Reach out to us if you have any questions or just want to stop by and say hi or update your financial plan. Thanks again and have a great rest of summer, everyone.
Thanks, everyone. Take care.